claims coming in right at expectations, 216. Pretty low level, underscoring the issue. Markets are worried about an imminent recession, but the economic data, it's a little softer, isn't supporting the recessionary concern. Let's take a look at the Goldman Sachs Economic Surprise Index. You can see it's not negative, it's about zero, which means you have a lot of surprises and a lot of disappointments there, pretty much ending up, surprise index is zero. You can see, though, earlier this year, we were really surprising to the upside. That's gone away. Now I want to look at the economic fundamentals three different ways: where the data is trending, the performance relative to expectations, and the level relative to long-term averages, because there's information in all three of those things. So let's take a look now at a variety of indicators. Retail sales have been up compared to where they were. They beat estimates, and they've been above the long-run three-year average. New home sales up in direction relative to last time, beating expectations. All three of those you can see right there, except for auto sales. Directionally, we're down just a little bit, but they are above the three-year average. Now we'll look at some of the other data that's out there, and you can see a little bit worse. Jobs have been down a little bit, but still, and a little bit below the three-year average. It's still pretty a decent number there. Those Fed manufacturing surveys have a lot of people's attention, things like the Richmond Fed and the Philly Fed. They've been directionally down, missing expectations, below their three-year average. Business investment, small business confidence, consumer confidence, all above their three-year averages, but directionally down and missing to the downside. Now I want to wrap it all up in a neat Christmas-type bow and see what the economic data tells forecasters about current and near-term growth. And all of this is positive, again, contrary to the market's direction here. 2.9% CNBC Rapid Update is tracking for the fourth quarter. And Q1, the forecast, no actual data there, but just the forecast, still pretty healthy, running about a point or a little bit less above long-run potential. So why this difference between markets and economists? Probably a lot of these X factors like Fed rate hikes, the long-run impact of that, the impact of the government shutdown, and the trade war. Morgan, we got a report this morning, for example, from Goldman that estimates the shutdown will cost 0.1 to 0.2 of GDP. Other folks say the trade war, 0.2 to 0.3. Add those up, 0.1, 0.2, 0.3. It starts to add up to, maybe as much as half a point from other factors, some of those X factors we talk about.